So actual stock market investing, you started from 2001, is it? Or you started much before that?
I was a floor trader in Madras Stock Exchange in 91.
Our today's guest is G. Maran, Executive Director at Unifi Capital. We discuss unique data points like Punjab having more vegetarians than Gujarat and how this can affect the stock market. This podcast is packed with many such insights that will shock you.
The travel and tourism, maybe this year, next year, will overtake the size of Indian IT industry. The Tamil Nadu tourism is the largest in India.
Oh, is it?
Yeah. Who are the biggest sellers in market? Not FIIs. It's actually promoters. FIIs own 21% of India's market cap during COVID time, when we had $3 trillion market cap. When we reached $5 trillion market cap, FIIs own 16%. Does that mean they sold 5%? They didn't.
Very interesting. Only 1 out of 100 women in India consume alcohol. 1 in 5 men do.
Last year, Indians spent more on liquor than on jewelry. It was disturbing to use something in silver in a place which is supposed to be called as Golden Hall. I did a trade. I was off buying 3 kilos of gold and made that in gold. Why I'm highlighting it is that place, the roof is made of gold, and you will find 23,200 plates of gold, and each plate should be more than a couple of kilos.
Oh my God. So 23,200 plates, each plate is 2 kilos. Mr. Radhakishan Damani. So what's something that you've learned from them?
He gave a 20 minutes speech, all with storylines. How an entry into Infosys came in 94. Hero Motors came in several businesses like HDFC Bank. What is common in many of this?
Was one study that you did where 2021 if you buy, where promoters were buying after 3 years, if you sell, 70% of the time you will get return between 10 to 35%.
All you said is right except the
You know, the most interesting part which I got to know about your journey was that when you teach students also, you have made some specific cards. And I thank you so much for giving the cards here as well. So these are cards where you basically have mentioned the most surprising facts about the Indian economy. And if I can just open a few of them, which you've given it to me. So if I just read out a few data points and we can then listen from you as well. The first card has India has the highest number of vegetarians in the world, though only 3% of South Indians are vegetarian. Okay, so this is like the first card. And there are like
additional
52
data
cards,
point
right?
there
Hmm.
is Punjab has more vegetarians than Gujarat.
Oh, is it? Okay.
67% of Punjabis are vegetarians. Just around 65% of Gujaratis are vegetarians. While this fact is easy to digest, what I just mentioned, many people will find it hard to accept. See, what has happened is we all create perceptions on data. And when data change over a period of time, we don't change our perceptions. When I studied in school in 1970s, I read India is an agrarian economy, which it was. But if I carry the same perception today, when agriculture is not even 14% of our economy, then there will be a gap between my understanding of India and actually what it is. So why we choose schools to do this exercise is that's where you find huge gap between the perception and reality, because they tend to get taught by people who grew up in different timelines, and therefore their perception of the country is shaped by what they hear, what they are taught. So this is a small exercise to make them be aware of India as it is, instead of being aware of India as what they were taught.
No, this is very interesting. And like all these cards have something which is so interesting. Like I've never imagined these kind of data points. So, for example, this one also, more medical doctors graduated from colleges in India in the last 10 years than in the previous 60 years. Wow.
During COVID
Mm.
in 2020, we just had 8.5 lakh doctors. There are, of course, 10 lakh 30,000 doctors who are members in Medical Council of India, but only 85% of them practiced here. Few of them passed, left India and practiced elsewhere. Last 1 year, India produced about 1,28,000 doctors. Total number of doctors India produced and alive and practiced in India 2020 was 8.5 lakh. Last 1 year was 1,27,000. So the last 5-6 years, India has produced more doctors than what we did for 40, 50, 60 years. That is one bit of challenge. See, the WHO recommended rate is one doctor per thousand population. That's global recommended rate. But if you have 140 crore population, and if you have just 8.5 lakh doctors, you're in serious trouble, which we all realized at a time like COVID. Now, this year we are just crossing that 14 lakh doctors. So now we are in WHO range. But the challenge is the dispersion, divergence within India. For example, if you come to my city, Chennai, you have one doctor for 380 patient population.
How much population?
For 380 people, you have one doctor.
Okay, 380 people, one doctor.
Even though India average is not even 1 for 1,000. The doctor population ratio in Chennai is actually better than even New York.
How much is it in New York?
Somewhere closer, but little less.
Okay.
The challenge is in states like UP and Bihar, where in the eastern UP you may find several districts where there may not be even one doctor for 30,000 people. So more than half of the doctors who graduated, there is a legacy reason also. If you take most of the medical colleges opened from 1947 till 1980, about 25% of them came up in Tamil Nadu. Almost half of them came up in South. And therefore, you naturally tend to have more doctors in South. Whereas in the northern belt, the UP, Bihar, that side, you will find the doctor patient, doctor population ratio alarmingly low. But the progress we have made in the doctor population ratio, now we are very close to WHO recommended range, which is one doctor for 1,000 population. So for 140 crore plus people, we have 14 lakh doctors. At least here we have made progress, but we have miserably failed in the nursing side. The same WHO recommended range is to have 3 nurses per doctor, which means if you are producing 1,28,000 doctors like India produced last year, we should have produced 4 lakh nurses. But we did only 2 lakh nurses. But even within these 2 lakh nurses, about 1/3 of them got placed in Gulf or Europe. So we have a serious shortage of nursing talent, which is why you may actually find the incremental compensation for nurses, the growth in their compensation in the last 5 years is actually more than the growth in the compensation of the doctors.
So you're saying nurses' incremental salary is increasing more than the incremental salary of the doctors?
That will be the trend for another
Oh.
5-10 years till
Okay.
that gap gets narrowed. And some of these insights, when you present in schools and colleges, it helps them to make better career-oriented choices.
Right.
Because when India had not even 1 lakh, 2 lakh engineering graduates with a technology background coming out in 90s, there's a huge shortage of talent. And those who came out of colleges got a very attractive compensations in IT firms. But if you ask what is the average salary increase of the top five IT firms between, say, 10 years back and now, how do you calculate the average salary increase? Total salary cost divided by total number of employees. If you do this for top five IT firms, you'll be shocked to know that that hasn't gone up in the last 10 years. Not inflation adjusted. In actual terms, it hasn't gone up. So if you're a fresher from college entering, say, an Infosys or TCS, and you got 4 lakhs per annum in 2014, you got 4 lakhs per annum in 2024. And the reason is demand supply. If you have 14, 15 lakh engineering graduates with IT major get qualified each year, and you have openings of 4 or 5 lakhs, why would salary get increased? On the other hand, in nursing profession, if you have yearly opening of 4 to 5 lakhs and you have yearly supply of less than 2 lakhs, you will have pricing power coming to them. And these insights, when you convert with some of these data, could bring more clarity to the students than in any other form and manner you can communicate.
So, something similar trend in CA. So, I've done chartered accountancy, and I was talking to one fund manager. I was telling him the same thing. 2014 average package of a chartered accountant was 10 to 11 lakh per annum. My friends have graduated and they've become chartered accountants, and they got that package. 2026, my friend who got placed in a big four last year, he got a package of 11 lakh rupees per annum. So the incremental salary jump is almost negligible. In the last 12 years, 2014 it was 10 lakh rupees per annum. 2026 it's 11 lakh rupees per annum. Similar to what you said in the IT industry, which is close to 4 lakh per annum. Even in the chartered accountancy or the commerce segment, the salary rates have not gone up.
That trend, sometimes you can compare profession to profession, sector to sector. You can also compare companies within that sector. For example, take our industry, financial services industry. Banks form large part of the industry. Take two banks, State Bank, ICICI Bank. Both are reasonably comparable because similar market caps. So I'm not comparing apple with orange. Similar sized, at least from stock market point of view. They are fundamentally very different, both by ownership as well as business practices. But in terms of market cap, these two are comparable names. If you take the average salary, how do you calculate? Again, total salary cost divided by total number of employees. Many people may think ICICI Bank is more than State Bank. And in reality, it's not. Average is actually higher in State Bank than ICICI Bank. And then you check how much they have grown over the last 10 years. In State Bank, it would have actually grown in double-digit CAGR. Whereas in ICICI Bank, it would not have grown. If you combine this with the fact that how much is the annual churn of employees? In private banks, you might have seen 25 to 30% annual churn. What is the churn State Bank had? Some 0.3% per annum. Okay. And then combine this with another data point of women as percentage of the workforce. If you take IT industry in 2014-15, women made up about 15-16% of the workforce. Last year, it was 37. Actually, TCS, it became the first company where it crossed 40. So when you read in newspaper these three distinctly differently at different time intervals, you don't get the story right. But when you combine these three data points, that between 2014 and 24, in Indian IT industry, average salary hasn't grown at all. Women as percentage of the total workforce has moved from 15-16% to 38-40%. And you had annual churn of 25-30% per annum, then you will get the story clear that the salary hasn't risen because you have large supply, and the supply people coming in are willing to do the same work at the same salary. Therefore, why should salary increase? In that story, if you validate with this industry, financial service bank industry, SBA salary increase was not a function of demand supply. It's function of pay commission, what is fair rate to pay, dearness allowance, all those. In ICICI Bank, it is demand supply. And therefore, if you can live with 25% churn a year and not having to consider any increase for 10 years, they will do it. State Bank won't. So you may have this resulting in one another phenomena, which I'm sure you might have heard about, income inequality. Several companies have to disclose the data of how much you pay for the directors as a percentage of the median salary. This was not a requirement 10, 20 years back. It became a recent regulatory requirement. Why do we do that? The reason we do that is to measure the level of inequality. Yeah, I'm sure you might have heard about this gentleman, Thomas Piketty, who wrote about inequality and has been um, uh, doing extensive research and even advising global institutions, governments on measures that they have to take to bridge this gap. So he has a ratio called T10B50 ratio.
T10
B50.
Okay.
So that's a tool to measure the inequality. For example, you take a bank. ICICI Bank has maybe 150,000 employees. I may be wrong here and there, but that's the picture. That's the range. State Bank may have 230,000 employees, right? But State Bank pays higher salary for 230,000 than what ICICI Bank pays for 150,000. The T10 B50 ratio is, if you are ICICI Bank and you have 150,000 employees, what is the average salary of the top 10%, which is 15,000 employees? And what is the average salary of the bottom half, bottom 50% of the employees?
This is 75,000 people.
75,000 people. And if you do T10 divided by B50, and if you get a number like 5, which is where the degree of inequality gets measured from. For example, if you take most Scandinavian countries, and if you take the total population households, T10 divided by B50, if you do this, the whole country, the number will be around 5, 6, 7. Which means these are all countries with the least inequality. If you do this for State Bank, 230,000 employees, you take the top 23,000 employees. Of course, for a minute, don't count other allowances they may get in terms of chairman's house. That's hardly one chairman, 10 DGMs, like that. But if you just take financial compensation, the T10B50, I may not have a precise number, but it is around 5 to 6.
For SBI.
The top tier employees may get 40, 50 lakhs. Bottom half of the employees get about 9 lakhs. In ICICI Bank, you may find that number more than 30.
Oh my God, 30.
The top 10% employees may get a crore or two. The bottom half of employees may not even get 5, 6 lakhs. India is now close to 23. There are several IT firms in Bangalore where this ratio is above 100. 100. In our own industry, fund management stroke wealth management industry, this ratio is alarmingly high,
How much?
40, 50, 60. As a country, we are at 23. US, I think, is around 17, 18. Um, Russia may be around 55. Saudi Arabia may be 70. These are all countries where the top 10% rich may be extremely rich, but the rest of the population may be average poor. So the degree of inequality um, is calculated not based on how much that rich 1% has. It's not counted based on 1 and 99. It's counted the T10 and B50 bottom half. And that can sometimes give you a sense of the corporate culture and many other insights. And when you combine this with the gender participation as well as compensation level, you can form a good story of where the supply is coming in, where the demand is coming from. And these data points in isolation may not bring any great economic value, but when you put this in context of something else, you will get uh, good insights.
Which is one sector that has very good ratio of, let's say, 5 to 6, which has no income inequality?
Because this is about T10 B50, majority of the manufacturing side businesses, you may not find huge divergences. There may be few exceptions, but in general, in whether you are taking, say, an automobile industry or textile industry, you won't find such huge divergences. Um, Maybe financial services, IT, um, even in pharmaceutical, we don't find such wide divergences as much as you see in IT and financial services. Uh, it is not just a reflection of um, it's a reflection of combination of factors. I'll touch upon one or two of them. When we got independence in 1940s, our literacy rate was about 12%. Actually, it's 14% male, hardly 7-8% female. What is that? Literacy rate. Those who can read and write. Hmm? The graduate number was pathetically low. There are hardly few colleges, universities. The significant investment that went in 1950s, 60s, 70s, 80s in education, higher education, mostly were South-centric for different reasons, partly political, but beyond that also, South had fortunately good elementary system, and therefore you had. And in the last 10, 15 years, the gross enrollment rate had been rising in colleges. Some of that we discussed, like doctor ratio, even engineering colleges. To give a number, about 2 years back, we had something like 45 lakh undergraduates coming out, 18 lakh postgraduates coming out, 1 lakh 10,000 doctors coming out. And this output ratio is playing a role in the unemployment number. And many people use this number similar to the way they use in Western markets, because we have some kind of a fashion in India to discuss certain parameters, certain economic variables, um, because people in the West are talking about it. One such number is the unemployment number. And when you ask people, how do you define unemployment number? So when US says their unemployment rate is 30-year low, 2.3%, it's a sign of strong economy. What do you mean by that? If unemployment rate is 2.3%, does it mean 98% of Americans are employed? Many people think so, while it is not. There's something called employment rate in US. That employment rate in US is only 71%. Unemployment rate is 2.3%. So what about the rest? The rest are people who are not employed and not looking for employment. So unemployment rate is equal to not 1 minus employment rate. It is number of people who are not employed and looking for employment. Which means if you have 100 people population, half of them are women and one third of them are married and they are not looking for employment, they should not be counted in unemployment rate. Of all the graduates who come out of colleges who are looking for employment and not having employment should be counted in unemployment rate.
Right.
Whereas in India, the unemployment rate has been rising. It used to be 3-4% 10 years back. In between, it went to 8, 9, 10% as per government. As per other sources, even higher number than that. People think that as a negative point. But if you ask, what is the employment rate of India during the same period? That also has moved. It used to be only 34-35% in 10 years back. And now it is close to 39-40%.
Employment rate.
Yeah.
That's very low, right?
It's actually yes and no. That employment rate, which is 39%, male employment rate is close to 63-64. Our female employment rate is hardly 16-17. And that number, we could not see significant progress in the last 10 years comparatively because 10 years back, we had certain social programs which offered 100 days work. The 100 days work program means 2 days a week. So the definition of employment rate is if someone is rightfully employed for at least 2 days in a week, they should be counted as employed. And since government had a large 100 days work program per annum, they were all considered as part of employment before 2014. And in the last 10 years, you have had a larger proportion of Indians in the working age and a larger proportion of Indians coming out of colleges. I'll put that in a numerical sense, easy to understand. Let's say 2-3 years back, we had 69 lakh graduates came out of colleges, 45 lakh undergraduates, 14-15 lakh postgraduates, and more than half of them are women. If all these women graduates who came out of colleges decided not to go for employment, what will be the impact of that in unemployment rate? It will come down. Is it good sign? It's not. There is one missing variable called labor force participation rate. That actually is rising. So we have been conventionally having lower women participation rate, which is why the women employment rate, which used to be 14-15%, looks like 17-18%. It may look like really marginal growth, but if you look granularly, the 14-15% also included the 100 days program and rural women, which were counted in the employment number. But this 16-17, you could see urban participation, women participation happening significantly. And therefore, it's just a beginning of a longer term trend. Probably 5 years, 10 years from now, you may find large number of graduates coming out, um, and larger proportion of that graduates looking for jobs, and labor force participation rate will go both on male and female gender, and temporarily it may show as higher unemployment rate, but unemployment rate rising along with employment rate rising is a sign of demography, and it's not a sign of economic weakness. In global countries, when you see unemployment rate rising without employment rate rising, that's a sign of their stress. So, some of these factors we should see in Indian markets, Indian economy, in the context of India.
So in India, you're seeing unemployment rate is rising as well as the employment rate is rising?
Yeah.
Okay.
Which means more Indians are employed today than what they were employed 5 years back. And
Hmm.
more Indians today are looking for employment than the number of Indians looking for employment 5 years back. That's the inference one should make.
Yeah.
We have a demographic situation which will continue for a while. For example, we crossed 100 crores population in 2001 census. Okay. We are going to do census maybe next year, 2027. The first census when India crossed 100 crores was 2001. At the time, we had close to 40 crore children aged below 15. And all those have become adults, including you, right? And they have not produced 40 crore children. Today, at 140 crore population, we have less children in India than the number of children we had when we had 100 crore population, which means large proportion of current population is coming to this age group, which matters in employment. And therefore, when you have a larger proportion of the demography, the population coming into this group, you will obviously find a larger supply of employment pool. Finding job for entire supply each year incrementally 2 million more, 3 million more is technically very difficult. It's not impossible, but that's not that easy. But you may find new openings. There may be some time lag, maybe 1 year, maybe 2 year, 3 year. But during that period, you will find employment rate rising as well as unemployment rate rising. That may run for a few years from now. But you may find that changing region to region. See, in all this analysis, one common mistake many of us in stock markets do is to overgeneralize whole India into one. When we talk about unemployment rate, we talk about India unemployment rate. When we say consumption slowdown, we talk about India consumption slowdown as if India is one country. It is one country for political setup, but it is not one country when it comes to economy. Right? The demography is completely different. For example, if you take the city I come from, Chennai, it will become the first city in India to cross median age of 40 very soon, not too distant in future. On the other hand, UP and Bihar will continue to have a median age of 21. After competition in Chennai, who will beat us and cross median age of 40 maybe sooner would be Coimbatore. This is again Tamil Nadu. Because in the last maybe 15, 20 years, the average child per woman in whole of Tamil Nadu, I'm not counting just Chennai or Coimbatore or urban, I'm counting whole of the state. The average child per woman is lower than Europe. When you have 1.2, 1.3 child per woman, and your life expectancy rates are rising during the same period, so you will end up having more elder population and younger children. Today, if you take all the Indians aged above 70, maybe every seventh guy you can find in Tamil Nadu. 14-15%, while we are only 5% of India's population, maybe more than 10% of India's elder population. And therefore, the median age will cross 40, maybe by 2035, 36. But what we are going through now is the peak phase. Over the last 15, 20 years, you had less children and more working age population, right? And when you have a larger proportion of the population in working age, the economic output can be uh, very high. And we were fortunate because you had higher literacy rate, lower mm, household size. We are the lowest in India. The average household size of India, if you put in a tabular form, you may find Tamil Nadu in the bottom, with hardly 3.2, 3.3, even lower than Kerala, right? And when you have, and Tamil Nadu is one of the, maybe one of the, not one of the many states, one of only state where you may find more than half the population urbanized. So when you have more than half the population urbanized, and you have nuclear families, and you have higher literacy rate, and you have larger proportion of population in the working age, you will find many economic drivers pushing, which is why when last year whole of India is struggling to grow 6-7%, Tamil Nadu would have grown 10-11%. And what is driving that growth, many people may see from stock market point of view as IT or pharma or auto. But people find it hard. Recently in one of the school where we were talking about know your country, we were asking the question, which state in India gets most of the foreign tourists? Or basically, which state has the largest tourism business? Many people think tourism is a niche industry. The travel and tourism, maybe this year, next year, will overtake the size of Indian IT industry. Okay. In our $4.2 trillion GDP, IT is about 250 to 300 billion, and tourism is almost there. But if you ask people which place has a vibrant tourism industry, especially say foreign tourists, people talk about Goa, Rajasthan, Varanasi, Delhi, Kashmir. But if you tell them that Tamil Nadu tourism is largest in India,
Oh, is it?
yeah.
Okay.
But the missing factor is medical tourism, especially in the last 4-5 years. It's been significant contribution to tourism also came from medical tourism.
What is medical tourism?
People visiting a place for a medical treatment, and because there is a cost arbitrage. So you will find in city like Bombay, you will find quite a few from Middle East. So they come with family, they stay here in nice 5-star hotels, get top class treatment, which still may cost together much less than what otherwise it could cost. So that's medical tourism. Today you may find little more than 1/3 of it originating in Tamil Nadu. And those drivers are working in favor of the South, where you have average child per women. It's not just Tamil Nadu. Even if you take Karnataka, Andhra, Telangana, Kerala, maybe 1.3, 1.4, 1.5, while India average is still 2, because there are other states which are still at 2.5, 2.8. And when you have more urbanized population and more adult as a percentage of the total population, and you have more literate family, then you will find drivers of that economy kicking in. But if all this generation turns older and retired and become dependent, maybe 15 years from now, and you don't have proportionate growth in child, you may find some of the drivers of economy missing out. For example, whenever any new age business comes up, which is like a smartphone manufacturing or electric vehicle manufacturing, why do you find most of these companies going to one or two places in South? Is it because those governments give them some incentive or some kind of benefit? Actually, no, because that's where you find enough talent pool. It's easy to recruit large number of people because there is an ecosystem where you will get that supply of talent. And if that doesn't remain 10, 15 years from now, there will be less incentive for a multinational company or a tech-driven company to go to that region if they can get similar talent, similar number of talented people in other geographies, maybe with even lesser cost. And why this matters is to answer your first question. Is some of these perceptions that we carry could be very different from the reality, because the perception is driven by certain data points. But when data points change 5, 10 years from now, we may find that gap widening.
Very interesting. I'll take the last card because there are 52 of them. So I'm sure in the interest of time, I'll just take one. So this is interesting. Only 1 out of 100 women in India consume alcohol. 1 in 5 men do.
Yeah.
So this is fascinating.
It's
And
also, but this 1 in 5 would also differ state to state.
mm,
Actually, if you take a state like Telangana, it's almost 1 in 2 men. Um, the while we are only about 17-18% of Indian consume alcohol, we are already a very large alcohol market. Last year, I think Indians spent more on liquor than on jewelry. The entire Indian jewelry retail market last year was about $60 billion, and Indian alcohol market became more than that. So Indians spent more on alcohol than on jewelry last year. But that alcohol consumption, if you just take South, that is Tamil Nadu, Kerala, Karnataka, Andhra, um, where you find 26 crore population out of 140 crore, that's about 18% of Indians. They consumed as much alcohol as the rest of 82% in India. So West plus North plus East plus Central is as big as South. But that's not the perception people carry.
yeah, I think I didn't know that people in South would consume alcohol much more.
South alcohol market is as large as rest of India. Not in volume, in value.
Yeah. And you're saying that people are spending more on alcohol as compared to jewelry. So this is the first time it happened last year?
Last year.
Okay.
Always Indian jewelry industry is a very large industry. We used to import 800, 900 tons a year per average for the last 10, 20, 30 years. See, till 1971, gold was a set price to a dollar, and private possession of gold was even illegal in US. From 1929 Great Depression till 1971, gold was set at a fixed dollar price from 1929 till 1971. When it got opened up, then you had gold price rally, which Indians benefited a lot. But the household acquisition of gold continued. And that average is about out of 3,400 tons a year, which is total gold mined over the last 10, 20, 30 years each year. 1/3 of it was Indian consumption, and more than half of that was South. That gold consumption, which was an average of little under 1,000 tons, close to 900 tons, in even 2013-14, actually has been falling in the last 5, 6 years. Partly to do with price, but I think more to do with demography. Today, if the median age of India is 28, and 2/3 of India is aged below 34, and half of them are women, women in 20s, 30s buy less jewelry than what women used to buy in 20s, 30s in the previous generation.
Why is that so?
In previous generation, the gold was considered a proxy savings, and it is as good as currency. And in rural economy, the family investments were denominated in terms of gold, which is not the case today. You have several choices. So the average demand of gold in jewelry side is now only 600, 650 tons as against 900 plus tons 10 years back. So according to me, it's the beginning of a long-term trend and it's nothing to do with price. But one mistake you could find many people doing is they're considering the financial buying of gold and jewelry buying of gold at similar importance. A central bank replacing a jewelry buyer is very, very different. A jewelry buyer is never a future seller. A central bank is a future seller.
Yeah.
If you take the gold price from 1991 till 2002, not talking long back, I'm talking about hardly 20, 30 years back, the gold price in India was at same levels, 91 and 2001, over 10 years, in spite of rupee depreciation, all that. Because globally gold prices declined by a wide margin. And who's the biggest seller of gold between 91 to 2001? Not mining companies, central banks, right? So when jewelry buyers dominate the demand side, gold can be an investment. When financial buyers dominate gold, gold can be a trade. What is the difference between an investment and a trade? If this cup is worth 100 rupees and I'm making that assessment based on the cost of manufacturing, the labor involved, the logistic cost, retailing, margins, and if someone sells it at 60 or 50, I will buy without knowing when I'm going to use it or without knowing to whom I'm going to sell it to. If I'm a trader, even if I know that it's worth 100, if you sell to me at 110, I will still buy if I'm confident of selling at 130 to someone else. A trader's decision is triggered by his entry as well as his exit clarity. An investor, when he buys, he doesn't care about exit. He considers what is worth. So gold trade is very different from gold investment, but it's a thin line which people are not noticing it. So when you have a 35% demand creator of an asset class slowing down or moving away, you just can't replace a 35% customer with a financial investor, which means it's still a good trade, which means financial investors buy, price could go up, but that you can't take a 10-year, 20-year view based on a financial investors buy and based on your understanding of the last 20, 30 years of price growth.
So now what people are doing, gold trade or gold investment?
Most people do. Those who have been doing gold investment, even today, if you take the gold that is retail, which is the 600, 650 tons that is retailed as jewelry in India, from 1970s, 80s, till even 10 years back, two-thirds used to be urban, one-third used to be rural. Now it is exactly ulta. 62% of the gold retail last year were rural. Urban jewelry consumption has not been growing.
Oh, I thought it's
But,
the other way around.
but actually, we now have several listed companies, unlike 20, 30 years back. And therefore, their growth is being taken as a proxy um, of jewelry retail. But what you are seeing is the total jewelry retailed in volume has not grown, but the organized retailing has grown a lot. So about 20 years back, the branded jewelry retail could have been 6-7% of the total jewelry retail, which is today maybe almost 29%. So I think in 5-10 years from now, we may find a slightly different demography and different demand creators. The jewelry retail in India may not grow as a sign of demography. Gold as an asset class may grow, but both are entirely very different from trade versus investment perspective.
How will this impact the gold financing companies?
Actually, gold financing company, um, this trend, at least for the next 5-10 years, longer than that, no one has any clue, may not have to be a concern. Rather, it is a great advantage because when you find gold financing company growing, are they growing in line with the growth in the jewelry industry? Actually, no. They are growing much, much faster. Why? They're gaining market share. From whom? From small, marginal, regional, unorganized gold finance company. So I'm sure you would have noticed 10, 20, 30 years back, you would have seen several small standalone pawn shops. And banks used to run, but the system that's required for a typical bank to have a gold finance operation um, is not commensurate to the trade economics. I still remember during COVID time when banks reopened with limited staff. And instead of 20 staff, you open the bank and run with 6 people. Will you put one of that 6 into the gold finance section? Because the size of each loan is small. And therefore, for bank to make this is a very competitive business, the cost structures have to be very different. The scale, the number of customers who serve, the turnaround time, all this matter a lot. And gold finance companies, therefore, are in an extremely sweet spot. They're not that worried or concerned or benefiting from industry growing or degrowing. This is a very, very large industry where the organized players were small and the competition that could come from organized players um, uh, is not a serious threat because you have the scale and cost advantage benefit in terms of this business with the other competition in the organized players. But the business moving from unorganized to organized will benefit the gold finance companies by a wide margin. And therefore, they don't have to worry about the overall industry not growing. And gold finance company is not about gold retailing. It's not. It's also about gold being held cumulatively. So, what is retailed? We are talking about 600 tons, 700 tons, 900 tons. What is in households is running into 25,000 tons, right? And therefore, um, what is the market for gold finance company? 600 tons or 25,000 tons?
25,000 tons.
That 25,000 tons is not dipping. And instead of growing at 4%, it's growing at 3%, the annual incremental growth. That's not going to move the needle. So, in terms of the industry size, gold finance companies' fortunes are not going to undergo dramatic change based on the consumption or jewelry purchase behavior of Indians. On the other hand, it can have a positive change because the business is moving from unbranded, small, marginal, regional players to organized, branded, large players.
So you are saying that retail gold is around 600, 700 tons, which is the jewelry buying by individuals, etc. And the household gold, which is stored in India, like
There's
from
no proper
generations, that
number
is
one would put,
25,000 tons.
but if you go by the historic data points available, um, that's the broad number, 25,000 to 28.
Wow. Yeah, I think this is around $4 trillion, right? The entire amount.
Yeah.
Much more than that.
Yeah.
Oh, wow. That's a lot.
And we are not even counting the gold, which otherwise you will find in temples.
Okay, that's separate. So this is only with households.
Yeah.
And how much would that be, like if we count it with temples and all?
No, it's very hard to put a number, but it's very large.
Even more than the households?
Not more, not double of household, but some reasonably comparable number.
Oh, wow. That's a lot. So,
About 3 years back,
hmm,
2023, I myself had bought some 3 kilos of gold. I was born in a place called Chidambaram, and there's a temple, Shiva temple, where the roof is made of gold. And that whole hall is considered, in Tamil we call this as Ponnambalam. Pon means gold, Ambalam means hall. It's a golden hall. And the main deity is Lord Nataraj, dancing god. And behind that idol, you will have a structure which holds this idol. It was in gold, but over 100, 200 years of usage, it became very fragile. And therefore, they use the golden one only once, twice, special days in a year. Balance 360 days, they use something which is in silver. So it was disturbing to use something in silver in a place which is supposed to be called as golden hall. So I did a trade. I was of buying 3 kilos of gold and made that in gold. Why I'm highlighting it is that place, the roof is made of gold, and you will find 23,200 plates of gold, and each plate should be more than a couple of kilos.
oh my God.
Yeah.
So 23,200 plates. Each plate is 2 kilos.
Each plate maybe 1 kilo, maybe
Yeah,
2 kilos.
sure.
I have not taken and
Yeah,
weighed
yeah,
it,
fair.
but it's running into tons.
So 40,000 kilo, 40 tons of gold.
Uh, maybe let's say half. Don't
Yeah, I mean,
let's
even
say
20
one fourth
tons.
of it. 10,
Yeah,
10.
that is
So it's
also a
running in
lot.
tens, right? Not
Yeah.
kilos. It's just one temple, right? So there are about 76,000 temples in Tamil Nadu.
So even if you assume 10 tons per temple,
Not 10 tons per temple, maybe even if it is 20, 30 such temples, like Tirupati, like Trivandrum, that if you count, it's much larger number.
Yeah. Yeah, I mean, even 20, 30 temples, and if you assume 10 tons, this itself is what, 300, 200, 300 tons of gold.
Yeah. And there will be several thousands of tons.
Yeah.
And because in our 16th, 17th century, even prior to that, the kingdoms used to recognize temples as storage of wealth, as a reservoir. You put when you are in excess and you draw it from it. And temples used to have their own charter, their own constitution. They used to lend. Temples used to lend to communities at times. They used to lend to kingdoms when they go out. So, and therefore, it's not surprising many of these temples have this kind of code.
Wow, pretty interesting.
Especially this one temple, in Chidambaram, where I was born, where I was talking about this. I was just narrating to a colleague. He lived in Chennai for a few years, and he was talking about chutneys. Right? So the
He was
entire
talking about what?
chutney,
Hmm.
the one sambar chutney that you have with
chutneys,
idli.
okay.
So till 16th century, whole of South used to have only chutneys as mode of eating. Karnataka used to have tomato chutneys, Kerala coconut chutneys, Tamil Nadu curry leaves. And because Tamil Nadu had 70,000 plus temples and each temple had so much gold, when we had the Mughal invasion and we lost most of this gold. And Chhatrapati Shivaji and Sambhaji came in and helped many of these temples to be rebuilt. And he stayed almost 42 days in this temple, which I just talked about, Nataraj temple. And he missed his dal as food every day. Apparently, from Satara, they used to pack the meshed dal in a semi-liquid, semi-solid form and send by horse to Chidambaram, where somebody stayed more than 40 days. And he'll get his weekly supply. And as soon as it comes, he'll boil water, add curry leaves, put this paste, and make, and what otherwise became sambar.
Oh.
So sambar actually originated from
Okay.
Sambhaji having his dal with water and curry leaves from Chidambaram.
Oh, wow. This is interesting. I didn't know this. What are some other food items or other things which were discovered like this?
The food, um, every year, budget when it comes, most of us as investors um, read newspaper, watch television, which product went up, which product came down. But one day before the budget, government releases something called Economic Survey of India. Several people work on it throughout the year and prepare. So sad no one reads it. But every report, the quality of the report, the data they command, the inferences they make is outstanding. And I showed one of the economic survey to a professor who teaches in an international college in Singapore, one of the top 5 MBA school. He couldn't believe that this is a government part of a budget paper because the quality of the research and the depth of data that was used. So in 2007, every economic survey of India will have one annexure. They discuss at length about one subject. And it's free to read. Just go to the Union Budget website. Every economic survey you can access. No password required. So 2017 Economic Survey of India had an annexure titled as Thalinomics, the economics of a thali. And if you read, you will get several insights of why the cost of fuel in a meal is high in Andhra and low in Goa. What a healthy male of age 30 consumes in South for protein and what he consumes in North, and how the patterns change every 150 kilometers. And it will give you phenomenal insight because, see, this is, if you look at our economy, 17% of our GDP is exports. 21% of our GDP is government and public services. About 60% of our economy is domestic private consumption. Almost one third of that is food. But if you see the time that we spend in trying to understand the exports and the time we spend to understand food, in terms of its impact on our economy, the domestic private consumption being 60%, and 31% of that is food. We don't even know who eats what. Whereas the smaller part of our economy, which is 17% exports, out of that 9 is maybe services and 8 is merchandise. And when Trump and tariff conversations were in full blow last year, that was only 8% of GDP, entire product exports, and 25% of that was US, which means it was 2% of the GDP. Yeah, 25% duty becoming 50% duty. At best could have a 0.5% hit on GDP. But we gave disproportionate amount of our mental bandwidth in trying to make sense of that 0.5% impact item. But what otherwise will have a big impact from food and eating patterns, we don't even read. Which is why we give sometimes very disproportionate amount of time. One common stuff I see nowadays is when people talk about oil price today with as much vigor and as much importance as they used to speak about it 15 years back. When we crossed $1 trillion economy in 2007-8, oil was more than $100 billion line item. Last year, whole of India, we spent maybe about 170 billion on oil. on a 4.3 trillion GDP. Today, oil is 3-4% of our GDP. 25%, 30% hit can take 1% out of GDP, but it's not going to make or break a country as much as it was in 2007. But somehow in our mind, we don't give proportionate importance um, to that. We still carry last time oil crossed $100. This is what happened. But the economic construct would have undergone dramatic change. And therefore, we need to be cognizant of that when we make inferences on this. Similar to the importance of food in our economic prediction, as much as you give importance to the exports.
What's the latest economic survey data saying about India, and what are some key insights you read in the latest economic survey?
The drivers of growth is so slow year on year, you don't notice it, but you suddenly see big change. I'll put that from our perspective as investors. Do you notice the constituents change in Sensex and Nifty on daily, weekly basis? You don't. We tend to think 30 stock Sensex, 50 stock Nifty, same universe last week, same now, same next week. Once in a while, we discuss one or two stocks went away, one or two stocks came in. Otherwise, in our mind, we tend to think Sensex today similar to the way we thought about it 5 years back, 10 years back. And some of us are very fond of doing this analysis that this is what the index gave over 20 years, 30 years, without knowing how much change that index has had. When I began my career in 91, if you look at Sensex, top 30 companies, of course, there was no Nifty at that time. Nifty came in post 94. In 91, the entire market cap of India was about $40 billion at then conversion price of 25 rupees. And two-thirds of the Sensex were steel, cement, power, textile. Not even a single IT firm, not even a single bank. No HDFC Bank, because HDFC Bank came post 94. No State Bank, because it became an IPO only in 93. So steel, cement, power, textile were two-thirds of the index in 91. In 2001, of course, index reached its new peak. That time our market cap became 100 billion, whole of India. But IT was one-third of it. And there's no real estate stock. Infrastructure is hardly 4%. But the entire rally in 2005, 6, 7, 8, infra, real estate, and many of those stocks came back to their prices only in 2019. So in 1991, had you bought steel, cement, power, textile, which was more than half the index, and held on to them till the next peak of 2001, would have made zero return. Even the largest company like Reliance, shareholder return between 91 to 2001 was zero. 10 years. Close to zero. I may be wrong with some decimal points or single digit points. 92 to 2001, 9 years, zero return. But in 2001, even if you had bought high quality company like Infosys and Wipro and held the next 14 years, you would have made zero return. Because that's the kind of 150, 160 P they were trading. In 2006-07, even if you had bought high quality name like L&T and DLF, you had to wait 12, 13 years to break even. Because that's the kind of high valuation they were commanding in 2007. Similarly, 2018-19 is fully quality stocks. HDFC Banks, Kotak Banks, Levers, Britannias, Asian Paints, which are now taking 5, 6 years to still break even. May take little longer. but the composition are undergoing a dramatic change, which is what I'm trying to highlight. Now, when steel, cement, power, textile was more than half the index in 91, in 2001, when index was new peak, they were not even 20% of the index. IT and pharma was almost half the index in 2001, which is now not even 20%. Similarly, last year, 2-3 years, we were beginning to see banks and financial services being 35-36% of the index. Will they be 35-36% of the index 5 years from now? Unlikely. Which means markets reflect the economic evolution, sometimes with a lag effect. Very rarely, sometimes you may find markets reflect the economy not entirely based on the sector's composition. When you see Sensex and Nifty, some people may misconstrue that as a barometer of economy, or for that matter, any index. What is an index? Index is a collection of companies based on size of companies. Just because you have 35% of the index in financials doesn't mean financials is 35% of economy. They're not even 8% of economy. IT may be 15% of the index, but they are only 7% of GDP. Tourism may be almost 7% of GDP, but they may not be even be 1-2% of the economy. So you will find significant divergences between the composition of GDP and composition of market. Similarly, you will find significant divergences in the industry composition in the market based on size of companies. For example, if you take banks, you may have several banks, but top 5 banks make up almost 75% of the deposits and almost 75% of advances. If you take IT, the top 5 IT companies is almost half of the IT industry. If you take, say, broking, maybe 2/3 of the broking industry is 5 companies. But that's not how all the industries are positioned. You may find, say, hotels as a large industry. But if you ask what is the market share of the largest hotel company, it may not even be 2-3%. Certainly less than 5%. So when you have large industry which is fragmented, you won't find large caps and you won't find large weightages. So many times the index A may not reflect entire economic change, evolution. Sometimes they will reflect with a lag effect. Sometimes they may not reflect the industry composition also. So this market that we are now witnessing over the last few months, where you are talking about index being volatile, no return, what people are missing to notice is the valuation mix is undergoing a change. For example, we had a recent peak in September 24. Even today, we are lower than those levels. The rally started post-COVID. January 21 till September 24, say, to point, let's take 3 years, September 21 to September 24. Sensex and Nifty would have moved 60%. 50,000 index became 86,000. Small and mid cap index more than doubled. Did all the stocks move similarly? No. You would have found shareholder return in HDFC Bank, 0. Kotak Bank, 0. Lever, 0. Asian Paints, 0. Britannia, 0. Bajaj Finance, 0. Between September 21 to September 24, over 3 years, when index moved 60% in large caps, 100% in small and mid caps. But during the same 3-year period, if you take top 500 companies, which include large cap, mid cap, small cap, that's anyway 90% of India's market cap. About 74 stocks moved with zero return or negative return. Basically, these 74 companies, PE multiples shrunk. That's what it means, right? If between September 21 to September 24, HDFC Bank delivered zero return, but their earnings grew 12, 13, 14% per annum. What is 12, 13, 14% per annum over 3-year period? Cumulatively 40, 50%. If earnings had grown 40, 50% and price is same, that means PE multiple has shrunk by half. From 5 times price to book value, they have become 2.5 times price to book. Even today, lever is at same price where it was 5, 6 years back. Of course, lever has grown hardly 5, 6% per annum. But what is 5, 6% per annum over a 5, 6-year period? Cumulatively, it's about 30, 40%. But stock price is same. That means PE multiple has shrunk by 40. And 90 PE has become 50 PE. So these 74 companies, about 15% of companies today, are cheaper than what they were 3, 4 years back. Market is close to all-time high, maybe 10% low. In a period when large cap index moved 60%, small and mid cap index moved 100%, there are 15% of the companies that have given negative return or nil return with PE shrinking. At least relatively, they are cheap. Maybe they were very expensive. Maybe they are now moderately expensive. In the same period, you had about 180 plus companies which have delivered return similar to their earnings growth. If IT companies have grown earnings at hardly 3-4% per annum, the stock prices have also grown accordingly. If pharmaceutical companies' earnings have grown 13-14% per annum, prices also have moved maybe 10, maybe 15, but in that range. Like that, you have about 180 plus companies. That's about 25% of the companies whose PE multiples are somewhat similar to what they were 3-4 years back. What about the rest? That's close to 280 plus companies. That's 60% of the BSE 500. These companies, current PE multiple is prohibitively high as compared to their own PE multiple 3-4 years back. If you look at the last 4 years, the average earning growth at Sensex Nifty level, large cap level, is close to 15% per annum. And BSE 500, which includes small and mid cap, is 18%. But if you look only small and mid cap in isolation, much more than 20% per annum. But stock prices, did they move in line with the earnings growth? No, they've grown disproportionate to their earning growth. Where is that disproportionate growth in earnings in share prices come from? They have not come from broad markets. They come from that subsection of the market which have had high earnings, which means today, do we say Indian markets are expensive? Some people say that. Why? Large cap index is close to 18, 20 times, which is expensive. Small mid cap indices were trading 25, 35 PE, expensive. But what one should bear in mind is the large cap, about 35% of the earnings in large cap stocks are coming from single digit PE companies. While the large cap PE index PE is the 20, more than 1/3 of the earnings are coming in single digit PE companies. That means what? 2/3 of the earnings in large caps are coming from companies which are 30, 40 PE. Similarly, while the small cap, mid cap PE is between 25 and 35 times, almost 1/3 of the companies are trading sub 10, 15 PE. That means 2/3 of companies are trading even more than 35 PE. As of last year, about half the companies are trading above 40 PE. So 60% of the universe is expensive, both in absolute terms, 40 PE, as well as relative to their own valuation in the past. But 15% of the market is cheaper today than what they were 3-4 years back. 25% of the market is neither cheap nor expensive, as fair as they were in the past. Now the choice is before you as an investor. You can argue, looking at the 60% of the market, that markets are expensive. I can counter argue, showing the other 15% of the market that they are cheaper today than what they were past. It's a function that over a long period of time, what matters is the earnings. You pick any company in any sector in of any size and check how much as a shareholder you would have earned over 10, 20, 30, 40 years. It will be very similar to how much those companies' earnings have grown. Pick any company, 1970s, 80s, 90s, even 2000, 2010. I gave examples of Infosys and Wipro delivering zero return over 14 years. Will be the outcome if you pay 150p. But what will be the outcome of not buying Infosys in 2001 or 1 year prior to that is huge underperformance, right? So the choice last 2 years is, do you want to buy the 60% of the segment where there's fantastic earnings growth, 9 out of 10 news is positive, 80% of the incremental money that comes into market is chasing them. They are indeed expensive, but becoming more expensive. If you don't buy, you have to have a fear of missing out. Most of these companies belong to railways, defense, power, capital goods, infra, new age businesses, real estate. That's where momentum is high. The fair side of the market will have few banks. Cheap side of market may have FMCGs, ITs, those kind of names. Cheap PE doesn't deliver shareholder return. Earnings deliver return. But earnings at any price doesn't deliver return. So it's a choice. The choice some people may exercise is, I will play momentum till momentum plays out. That game, few people are good in playing it, but looking at them if we play, we may miss out on the exit. Then you have to hold much longer, which many people are seeing it in HDFC banks, Kotak banks, Levers, Asian Paints. This is only the last cycle example. The previous cycle example in L&Ts and DLFs, people had to wait 12 years to get that price back. Prior to that cycle, you had Infosys, Wipro kind of examples where you had to take 14 years to break it. Prior to that, you had Reliance kind of name, which took 9 years to break even. Arvind Mills used to be a Sensex stock in 1994. And I think it took 20 years to break it.
20 years, no returns. Oh my God.
So that's the power of playing momentum and paying 100p. So it's a choice before. Now, people like us who have spent much longer years, 25 years, 35 years in market, exercise the choice of looking at that 15% of the market, 25% of the market, which is either cheap or fair. But what kind of companies will be trading cheap PE in otherwise an expensive market? Only those companies where the earning growth is depressing or inconsistent or uncertain. And eyes wide open when you go and buy such companies where the earning growth is hardly 6-7% per annum, when average earning growth is 18% and a section of market is growing 25%, you go and buy 6-7% growing companies because you refuse to pay 40p. Instead of paying 40p and buying 25% earning growing companies, you are buying 6-7% earning growing companies at 15-20p. But if the 6-7% earning growing companies continue to grow 6-7% in earnings, even 15-20p is high. But if the 6-7% earning growing companies become 20% earning growing companies in future, you will benefit from earning growth as well as potential P expansion. But if you buy 25% earning growing companies at 40p, as long as 25% earning growth continues, 40p will remain 40p, may even become 50-60p. But the first sign of weakness in 25% growth could bring PE correction, which would take several years to. So people who have a preference to play that game should play that game. But having underwent the cycle, We are clearly saw that cycle. This is third, maybe fourth time we are seeing it in the last 25 years. In 2018, when you had a good run in 15, 16, 17, and SEBI came with the mutual fund regulation, the market cap regulatory act. Till 2017, we didn't have regulatory definition of benchmarks. If you had taken a $2 billion company in 2017, Goldman Sachs would have called it as a small cap. HDFC Mutual Fund used to call it as mid cap. Unifi Capital used to call it as large cap, because we were defining company size based on the size we operate from. Then SEBI came and said the large cap definition is company number 1 to 100, which means the 100th company at the time was MRF, which had 24,000 crores market cap. The 100, 1 to 250 as mid caps, 251 to 500 as small caps. And then not only regulators did the definition of large, mid, small, they also said to mutual funds, you have to have a benchmark. It's up to you to choose the benchmark. But once you choose the benchmark, your portfolio should reflect that universe. So if you choose a large cap benchmark, then at least 80% of your holding has to be large cap. Right? And SEBI gave probably 1 year time for mutual funds to follow. But if you are a fund, like top 200 fund in HDFC, and you have investments across top 200 stocks, now you have to decide what is your benchmark. And you decide large cap as the benchmark. Large cap index, which means 80% of your holding has to be company number 1 to 100. But what do you do with the company number 101 to 200 you hold? You sell. Are you selling because you wanted to sell? No, you are selling it because you had to sell. And this rule was applicable to several mutual funds. So when all mutual funds sell, small mid caps will buy it. So 2018 became the only year, at least if you see large cap, mid cap, small cap line, all the years you will find large cap rising, small mid cap rising more. Large cap falling, small mid caps falling more, calling it a high beta segment. 2018 is the only year you would have seen large cap rising and small mid caps falling.
Why did that happen?
Because of regulatory reason, mutual fund selling. They were selling small mid caps and buying large caps.
Okay.
So if you are a momentum investor concerned about 1 year performance, you should not have had small mid caps. And if you look at our portfolio, probably 90%, 95% would have been small mid caps. So you may have run the risk of minus 10, 20%. And that year BSE 500 was positive, Sensex was positive, Nifty was positive. In fact, we were worse than all the indices. We were worse than even small cap index, right? But over the next 3, 4, 5 years, what was 100 in that became 111 in Sensex would have become 186. And what was 100 that became 105 in BSE 500 would have become maybe 212. But what was 100 in small and mid cap portfolio that became 84 would have become 312.
312. Oh, wow.
Which means the greatest edge we as investors have is not some superior stock selection skill. At least we are humble enough to accept we don't have that skill set. And we don't think as an investor anyone should think that way. Majority of the investors, some of them are friends when we speak, it's not that the successful investors had some unique skill sets or certain access to information flow better than a mutual fund. So what is their edge? If your edge is focus on absolute return and long-term outlook, you can afford to be a contrarian. But if you're a contrarian, you have to tolerate the near-term pain. If you're playing the near-term momentum, and therefore you are buying 40, 50p businesses, and you are buying it because If you don't buy, the outcome could be underperformance. Is the thought. You are not buying it because you genuinely believe that's a fair PE to pay. Otherwise, how do you explain last year who are the biggest sellers in market? Not FIIs. It's actually promoters. Many people think FIIs are the biggest sellers. No. FIIs own 21% of India's market cap during COVID time, when we had $3 trillion market cap. When we reached $5 trillion market cap, FIIs own 16%. Does that mean they sold 5%? They didn't. They didn't even sell 1%. When we had $3 trillion market cap during COVID time, when FIIs owned 21% of our market cap, 25% of that 21% was two stocks. So you take all the 850 FIIs who are holding $650 billion in a $3 trillion market cap of India.
Reliance, I assume, would be one.
And HDFC Bank. Okay. HDFC Bank, they held 65%. Reliance, they own 27% when promoters own 50%. So in these two names, if you own 50-60% of the free float, you are the free float. How much is the shareholder return last 4 years? 0. So FII selling is reflected in the stocks which FIIs are selling. If you have 25% of your money in 2 stocks and 60% of your money in 50 stocks, and that's not 50 of top 50, that's a 50 you assumed as quality 50. So FIIs own 650 billion on 3 trillion denominator, and denominator 3 trillion became 5 trillion, but nominator 650 billion became 850 billion. Government of India own 6% of $3 trillion market during COVID. Now they own 11.5% of $5 trillion market. Does that mean they put 5% of market cap? No. The stocks they had, whether it is state bank kind of names, they appreciated much more than the market. So what FIS sold, maybe 20 billion, maybe 30 billion, maybe 40 billion, out of 850 billion, which means FIS sold hardly 3-4% of what they held. Who's the biggest seller in market? It's actually the promoters, right? We had record collection in IPOs, but if you look closely in IPOs, 70% of the IPOs are offered for sale. When was the last time we had seen this? Never. So if you take previous cycles, usually promoters unwinding. This promoter selling, do you see in private banks, FMCG, IT, none of these sectors? And they're all more than half the market cap, which means the other half of the market, where you find 40p, 50p, or infinite p, is where you find promoter selling the most. But that's where you find the earning growth the most. That's where you find the news growth the most, the positivity in news. So that segment of market is very compelling, very attractive, but you find significant promoter selling. But the edge as an investor you have is if you are not really concerned about 1 month, 3 months, 6 months, sometimes 1 year, 2 year return, because you decline to pay 40, 50, 60 PE, you can save yourself from a potential PE erosion. But sometimes what happens, the expensiveness in market could stretch a little longer than what you. Sometimes the cheapness in market could also stretch longer than what you predict. About exactly 10 years back, uh, we did a strategy which focuses only on green. When our Prime Minister went to Paris and signed the climate agreement, and even though he signed it in November 2015, only in April 2016 it got gazetted. But once it got gazetted, it becomes it's a statutory obligation on the part of the country to adhere to set guidelines. I don't know how many people took the effort to read that, but even a commonsensical investor, if you had read, you would have found the alternate energy, specialty chemicals which are replacing hazardous chemicals, mining. Several of these businesses are likely to undergo dramatic positive change, especially, see, green doesn't mean green energy. Green energy is only subset of that. There are several aspects of green. So we said this is an industry which is undergoing tremendous transition. Let's focus. Let's do a thing. And we spoke to like-minded investors, raised capital, invested. First 1 year life was okay, 2017. Then 2018, Trump got elected and US walked out of the same Paris Climate Agreement. After seeing US walking out, several other countries walked out. There were some uncertainty about countries honoring the commitments, and entire green became some kind of a not a great word to anymore. And many of these businesses, they were all small caps, right? And coinciding with these SEBI regulatory change, small caps fell in 18, 19, and these stocks, which normally would have fallen 10, 20%, because of this fell 30, 40%. So our whole portfolio is down 30, 40%. But the homework we did had the conviction to hold on. And then COVID happened, post-COVID. Some of these at a fund level were growing 100% per annum. The top 3, 4, 5 of these holdings in that fund would have become between 5x to 10x, not 1, 2. The top 5, each stock. One went up 10x, one went up 8x, all in the last 3, 4 years. But the first 2 years is at minus 20. So which means if you are a bit contrarian, or if you are thematic, sometimes you may run the risk of little ahead of time, which we don't mind. But you should not get in too late. Getting in too late will have all the social proof in your favor except valuation. When you are getting too early, valuation is in your favor, but everything else looks uncertain. So a cheap portfolio, like the one that we have been focusing with the 15, 16, 17 POE, a cheap portfolio doesn't deliver return. We all are aware of it. It may help you in protecting capital, but doesn't deliver return. Earnings growth deliver return. But if the earning growth has to come at 40, 50 PE, it's better to pay nominal valuation, settle for lower earnings growth, and add value in stock selection, where at least there is potential earnings turnaround. Even if you get it wrong in 1 or 2 stocks, the balance is 17, 18 stocks, you get it cheap. So that earnings turnaround won't happen with time precision, like a clockwork. Sometimes you think it will happen in 2, 3 quarters. Sometimes it may take 2, 3 years. But as long as that earnings turnaround happens, and you have the attractive price as your advantage, it should come out handsomely.
So you said that promoters were the ones who were selling last year and not the FIIs.
FIIs are selling, but FII selling is concentrated in few. And where anyway it is obvious and apparent. Right? See, FII buying and FII selling should be when you read in WhatsApp every day that FII sold this much, DAS bought this much. Many people think DAS are buying what FIIs are selling. That's wrong inference to make. FIIs are selling what they are holding. DAs are buying what they want to buy. Both are different.
So DIs are not buying what FIIs are selling.
Take last 1 year, all the mutual funds, all the inflows that came. The largest inflow came in flexi cap category. Flexi cap has to buy X percentage of mid caps. They have to buy, right? That's not what FIIs are selling. You don't need statistical data points, which we can, of course, get if you plot all the names which we have. But you don't need statistical data points. A simple, commonsensical look will tell you The DAs are not buying what FIIs are selling, right? But that doesn't mean DAs are buying what will go up in future. DAs are buying for whatever reasons that is obvious about the earnings growth. DAs are buying where there is an earning growth. Why will a DA go and buy a bank because its price to book value has fallen from 5 to 2.5, when they can buy another bank which also trades at 2.5 or even lesser with a higher growth rate? So there is a good logic in what DAs are doing. So their mandate is not to go and buy what FIs are selling. But what I'm trying to highlight is FI selling negativity is narrow framed on some section of market, not broad market. Broad market, who is making good use of it? When you see some MNC promoters coming and doing listing, what is prompting them to do that listing? Better brand, market entry strategy, regulatory compulsion? None of it. Just valuation. Do we think that valuation is going to deliver good shareholder return in future? At least we don't think so. So even if it means missing out some upside in the near term, there's no point in playing that momentum game.
So I'd read in one of your previous interviews and articles that you said that there's one strategy called as the insider shadow strategy that you have, where if promoter is buying the stake in that company in his own company, then you should buy that stock. If the promoter is selling, you should sell that stock. And there was one study that you did where 2021, if you buy where promoters were buying, after 3 years, if you sell, 70% of the time you will get return between 10 to 35%. Right?
All you said is right, except the first point. If you had bought all the stocks that promoters bought and held 3 years and sell, you would have had fantastic return, much better than in even index. That doesn't mean you should sell when promoter sells.
Okay.
Promoter selling could be for 100 reasons. But promoter buying usually is for financial reason. Promoter need not have to sell each time a stock turns weak. But each time a stock can turn positive, a lot of promoters you may find buying. Promoters by nature are contrarians. And this is unique to India. See, today when we look at from India from stock market point of view, this 455 lakh crores, that's market cap of India in rupee terms. So 53% is promoters, 16% FIIs, 11% mutual funds, 7% domestic institutions other than mutual funds, 12% is retail. We are looking at what that 11% guy is doing and 16% the guy is doing. But we should also look at what the 53% guy is doing. And the perception is 53% guy remains 53%. It's not. Most of the cases, yes. But few cases is the biggest seller or sometimes he is the biggest buyer. Promoter buying is a good way to hunt for value. You will never find, is there any promoter buying in railways, defense, capital goods, infra, power, real estate last 3 years? Won't find. How many of the above 40, 50 PE stocks promoter buying has happened? But when COVID hit in March 2020, who's the biggest buyer? In October 2008, when you had a 60% fall, global financial crisis, Lehman crisis, who was the biggest buyer?
Promoters were the biggest buyer in both.
Yeah.
Okay.
In the last 20 years, the biggest promoter buying happened in October 2008. Second biggest was March 2020.
Oh, okay.
But last year, when promoters are biggest sellers, how do you run inside a shadow? You should be out. Like this, we have quite a few thematic funds. I talked about green as a fund 10 years back. We did one fund which is spin-off where we look at only demergers. Why do we do these thematic funds? Why not just call large cap fund, mid cap fund, small? You have all the freedom and easy to communicate, easy to benchmark. Whereas in these strategies, very hard to communicate. Maybe to a promoter, it's easy to communicate what is inside a shadow fund. He will get it in 5 minutes. Regular investor may especially if you're an NRI from US, you may find that as a negative connotation. Similarly, for us to go and explain a spin-off to a partner in an audit firm is easy. But to a regular investor, explaining the process of demerger and spin-off, and sometimes they may have a negative correlation. In rising markets, some of the stocks could fall. Sometimes you may find range-bound markets, some of the spun-off businesses growing dramatically. So you need to have some an inclination. Um, there was a book that recently came, um, the courage to be disliked. So you have to have that courage to be disliked at some time for you to pursue some of these strategies. And these kind of thematic strategies, while there is enough and more academic material to highlight the merit of them, it may not suit certain type of capital. Let's say I'm a mutual fund and I have to have a benchmark, and my products reach the investor through several not number of intermediaries, but the channel where I have to speak to product head in a national distributor, who in turn has to communicate with the RM. RM in turn has to have a team, and team has to go to meet the investor. So between the fund manager and the investor will be sometimes one layer, two layer, three layer, four layer. And if you also know that 58% of the unit holders redeem within 2 years, and 14% of investors stay longer than 5 years, which means what? My target audience can give maximum 2 years. If I underperform 1 year, I have to perform the next year. Otherwise, more than half my client is going to walk away. Then what is the merit in doing what I'm doing? If that is the capital, how can they do inside a shadow? How can they do spin-off? Actually, if you take spin-offs in the last 10 years and ask which class of shareholder sold the most on the year of spin-off? Is it promoter or FII or mutual fund or DAA or retail? It is mutual funds. Why? Because when one company becomes two listed companies and one of the spun-off company won't trade for 3 months, 6 months, and you get shares of that company which is hard to evaluate, and especially if a business that is being spun off is very small part of the existing listed company. Let's say I'm a 8,000 crore mutual fund and I have 5% of my money, which is 400 crores invested in a company, and that company is spinning off its electric business separately or a fan business separately, which may be 10% of that company or 20% of that company. And 20% of that company, I get shares, which is hardly 60, 70 crores. In a 8,000 crore fund, what am I going to do with the 60 crore position? Needle won't move. And this is not a stock which I bought. This is a stock which came to my DP account because I was holding that. And for me to do a research on this company, there is no street coverage readily available. So for me to, on a 0.7% holding, I won't be doing primary research. And most of such cases, they become sellers. Either it will be bought by a promoter, who, if we find this price is attractive because he's getting a block, or it will be taken by people like us. And therefore, usually you will find the business being spun off, even though there is a great merit over a 3 to 5 year period, the 1 year, 1.5 year return could be negative, could be lower than index, sometimes could be opposite side of the index. And therefore, these kind of thematic strategies may not suit institutional capital. Which is why we always say, what is your edge as an investor? It's very important. First, you have to convince yourself. The easiest person you can fool is you first, right? So if you are a retail investor and you think you have an edge because you can predict economic cycles better than an institution, you can predict geopolitical events better than an institution, you can predict the outcome of a war better than an institution, you are fooling yourself. At least in my case, I think I will be fooling myself if I tell you that. So what is my edge as an individual investor is to time arbitrage. If these guys have to perform every year or at least every second year, And if I have a 5-year outlook, uh, I can be a contrarian. I can get in much earlier, or I can buy when valuations are low, even though earnings uncertainties exists. And the absolute return focus is my edge. I'm not measuring my return in relation to index every day or every month or every quarter. There is a quote famous investor mentioned that the easiest way you can beat an index over a long period is to ignore the index in the near term. Yeah,
Wow.
that's the best way to beat the index.
Hmm.
Many people think beating the index over 5 years means beating the index every year for 5 years. Beating the index in 5 years means if you keep doing what everyone is doing each year, how can your outcome be any different? Right?
Yeah.
So if today 90% of my portfolio is different from the index, I'm not going to benefit from a rising index, which I know when I bought. Sometimes I may fall in a falling market. That is not because of index variation. That is because it's coincidental that my companies are weak and market is also falling. Right? People say, boss, you didn't go up in 24 when markets went up, but you fell in 25 when markets declined. It's not both same portfolio. It's different mix. And it didn't rise in 24 because you went into low P, low earning growth businesses, which were large, safe, defensive sectors. But last year, when we were making transition towards um, deep value, small, low P, small cap, mid caps, and those stocks were attractive, low PE, because their earning growth was low or uncertain or inconsistent. You have to wait till that earning consistency comes. If the earnings growth comes, you will benefit from that earning growth, even if low PE remains low PE. But usually, when the earning growth comes, low PE won't remain low PE, which is when you make outsized return. That return, if over a period of time, can make up much more than what a benchmark can do, which we have seen time and cycle. This is maybe 25th year of what we are doing. And over these periods, you would have seen this cycle. So in 2018, it was worse than what we are going through. In 2018, index moved plus 11, 12, and we were at minus 15, minus 16. But the outcome over the next 5 years um, made that one bad year look tiny. Hopefully, in the next 3 years, we will find the reversion to mean in
Yeah.
valuation. At the time, performing companies will deliver.
How many years it's been that you've been into investing?
I began my career in 91.
Hmm.
Then, after spending 10 years working with broking companies, banks, I joined three of my other friends. Four of us founded the firm. That was 2001.
So you started Unifi Capital in 2001. So actual stock market investing you started from 2001, is it? Or you started much before that?
I was a floor trader in Madras Stock Exchange in 91.
What is that? What does that mean?
Those days, we used to have regional stock exchanges, like Bombay Stock Exchange.
Yeah.
Madras Stock Exchange is actually the second oldest or third oldest in India, set up in 1934. So like that, we had almost 20, 21 stock exchanges before NSE came in 1994. And each broker can have 4 people going into the floor, actually doing the trade. Those days, it's outcry system.
Similar to what was shown in the Harshad Mehta series, that 1992, where brokers used to take some people.
They're all called badge holders. So you carry a badge, which allows you to do the trade. That's how I began my career in 91.
Oh, okay. So you've been investing in markets since 91, I assume, right?
Yeah.
So it's been 35 years. Wow. That's amazing.
But actually, in our industry, people glorify long experience. It may not mean a lot. Of course, when you spend 20, 30 years, you learn from your mistakes and you have that advantage, but it has a limited advantage. Many times people say, oh, this guy has 20-year track record, so he should be good. This guy has 30-year track record, which means he should be even better. While sustaining the track record over a long period is difficult, we should see the time period of that also. For example, if I had started my career in 91 and I show 20% return, even over 20-year period, today you are measuring that 20% CAGR as a great number because the cost of capital is 7%, GSEC yield is 7%. But in 1990s, the GSEC yield used to be 14-15%, right? AAA companies used to borrow 17-18%. At that time, if someone had done 20% per annum, you should not give the respect which otherwise he deserves by showing that 20% when GSEC yield is 7%. Right. So the long years of experience should be seen in the context of that experience. And that way, while 35 years is great, nice thing to say, it has only limited utility value.
Have you met Mr. Rakesh Junjunwala when he was there?
Fortunate.
And what was the most interesting conversation you had with him? What did you learn from him?
More interesting than him is the gentleman whom he considers guru. I was fortunate to have quite a few conversations.
Mr. Radhakishan Damani ji. So what's something that you've learned from them?
I learned more about life than about investing from them. How to stay humble.
Yeah.
How to listen. Why God has given 2 ears and 1 mouth instead of 2 mouths and 1 ear.
Right.
And why it makes sense. I remember the very first meeting I took my colleague from Chennai. By then I know him reasonably. I took one of my colleague. For my colleague, this was his first meeting. And we spoke an hour or two. While leaving, he asked, "Sir, we are all aspiring young investors from Chennai many years back. If there is one advice with which I can go home and become a better investor, what is that one advice you can give?" This is my senior colleague asking probably the most respected investor of India. He didn't answer for some time. And he didn't speak for a long time. Then he gave a 20 minutes speech, all with storylines. How an entry into Infosys came in 94. How entry into Hero Motors came in. How his entry into several businesses like HDFC Bank, VSD. And what is common in many of them is early exits and how to live with not 1, 2, 3, a series of underperforming years. And the courage to be disliked. It's glamour to benchmark. Lift the collar and show yourself, pat on the back after looking. That will eventually bring your averages closer to the industry. Why focus on what you make instead of focusing on what the neighbor is making or the competitor is making? But clearly take absolute return. And after he finished this talk, he asked the next question, saying, "Sir, you kept saying long term, long term, long term. Many people say that. What is long term?" This time he didn't hesitate. He didn't take time to reply. His reply was instant. He said 15 years. And then, my colleague asked, "What is that 15? Why not 10? Why not 20? Why 15? Then he was explaining how an economic cycle works. He explained from his business view, the kind of businesses that he got exposed to, and the kind of time it takes for a business to reach critical size, and how certain failures you can observe in year 4, year 5, year 6. And therefore, you should have the willingness to be proved wrong also. But after year 6, 7, once they cross that phase, how the next layer of growth gains momentum. And why in the last 3, 4 years of that 15-year period, the outcome could be several X, because the base effect catches on and management bandwidth increases. Several beautifully explained. I can't explain. Uh, um, so the learnings from them is not just about how to pick stocks or how to do the selling, but more about the mental framework to have, and how do you stay disciplined,
Right.
and not get either carried away by the size, or get down by criticisms.
Very interesting. I'm just getting so much positive vibes from you, and you're so grounded, sir. Even after achieving so much, like this is one of the most insightful and one of the most easy to do conversations for me. So it's all because of your humility. Thank you so much for that. I had an amazing time. This was super insightful. Last question that I ask all my guests. It's a tricky one. If you were in the shoes of Kushal Lodha and if you were interviewing Mr. G. Maran, what is one question you'd like to ask him towards the end?
If I were you,
Hmm.
irrespective of whether the other person is G. Maran or someone younger or someone elder or someone smaller or someone larger, um, I'll ask myself, what is dharma of what I'm doing?
So, what is dharma of what you are doing?
What is dharma of what you are doing?
Hmm.
Because I am Kushal, right?
Yeah. So if you are in my shoes and if you are interviewing yourself, so what is one question you would like to ask yourself towards the end?
What is the one dharma of you as a podcast
Hmm.
conducting the podcast is, there is a responsibility towards the audience. If that audience have certain perceptions about India or economy or the demography or the markets, and there is a gap in that perception from reality, the dharma is to highlight that. The dharma is not to present to them what they like to hear.
Yeah.
Sometimes dharma is to present to them whether they like to hear or not, which you don't know. But the reason is, I can speak to, the other day I was presenting to school students in BKC, maybe about 150 students for 10, 15 teachers. And I would have done this similar sessions, not one, two, several schools. Why do we do that? Is we realize our dharma is to communicate. While we hesitate a lot in speaking with media, which I am sure you would not have found in print media or even television, very, very, very limited. But we are extremely liberal in presenting in educational institutions, schools, colleges, CFA forums, several such forums. Because our dharma is to fill these gaps
Yeah.
wherever you find, whether you get paid or not. We actually don't get paid. The cost is not travel, the cost is the bandwidth, the time, which is most precious. So, if I were you, my dharma of doing a 1 hour chat is, if I can at least communicate with clarity one aspect about India. Today, you may find some experts putting targets on Sensex 1 lakh, Nifty 50,000, or India will be third largest economy, second largest economy. These are all English. It means nothing. But if you can communicate to them your high conviction on where the growth comes from,
Yeah.
and if you are a country where the drivers of growth is coming from places you least expect. And even though Bombay may be 20-25% of Maharashtra GDP, and along with the MMR and Pune, 45% of Maharashtra GDP is just two states. Bombay is almost 30%. And if you take the poorest districts of India, few of those districts you will find just 100 kilometers from Bombay. You can consider this as half glass full of glass empty, saying extreme inequality. You can also see that from where the next layer of growth is going to come from. So South is almost 18% of the population, but more than one third of the GDP. There is one slide which I will show you. You may find just the Gangetic Plain, UP, Bihar, West Bengal side, small part of it. That's half of India. The south part, hardly 4-5 states. That's 18, 20, 20. If you just include Maharashtra, that's 25% of population. The whole of the middle is 25%. But the 50% of India, which is on the northern side, you have low literacy rates, you had um, dependent population significantly low, and they were not participating in economic growth in the last 70, 75 years. You just can't blame them. In our industry, you may find people saying mm, mutual fund subscriptions raising 4,000, 5,000, 1,000, 20,000 crore. But if you ask how many investors actually invest in mutual funds, about 4%. But if you counter the question and ask how many Indians carry a credit card, 4%. When Prime Minister says only 5% of Indians file taxes, we all tend to think many people earn but don't pay. But if you ask them how many people have a passport, it's only about 6-7%. How many people have a car? 7%. So the economic progress that we had seen has come from probably the richest 20% of Indian households. So it's not 5% of Indians file IT return, it's 20% of Indian households which file IT return. And it's not 4% of Indians invest in mutual funds. It's 16-17% of Indian households have mutual fund investments. Why we highlight this is to communicate that the next layer of growth is not going to come from this 15-20%. They are not consuming 31% of their consumption is not food, which it is the average for India. So 16% of India's domestic consumption is travel. That's not for the richest 20. So the next 20 is going to be the biggest growth drivers, and that growth is going to come in a slightly different manner than the growth that has come in the last 20 years. And that is not sensitive to who is US president, who is waging a war in Gulf, how Russia is going to move, how Europe is going to behave. So to your target audience are spending disproportionate amount of time to factors which may be relevant today, tomorrow, but their relevance in their return generating career is minuscule. And that disproportionate amount of time in bandwidth in their mind, if it can be allocated to factors which are less sensitive to those events but more relevant in Indian context, which is going to play a dramatic role. So your conviction level on India's economic growth as well as market return growth will not be diluted based on one news you hear or 1 month development. So I think that is Dharma, and you have done a great job. I have seen quite a few interviews with learned people who have highlighted them. And to answer your question, if I were you in your position, I'll spend more of my time in getting that clarity right.
Amazing. Thank you so much, sir, for doing this. Didn't realize how the last 2 hours went, and I mean, it's just that it's so enlightening to listen to you, and it's just that I feel like as if we should just keep listening to you. I'd love to do a series with you where we can educate the audience on multiple topics. But thank you so much once again for doing this. You're one of the most humble human beings I've met, and thanks for guiding and educating the entire audience on so many topics. Thank you so much, and thanks for
Truly
the
my pleasure.
thanks for the lovely cards as well. I'm going to read all these 52 cards and for the book as well. Thank you so much.
Sincerely appreciate. Thank you.
अगर आपको ये वीडियो पसंद आया होगा तो आई रिक्वेस्ट यू टू शेयर इट विद ऑल योर फ्रेंड्स एंड सब्सक्राइब टू आवर चैनल सो दैट वी कैन गिव यू मोर वैल्यू एडिटिव कंटेंट इन द शॉर्टेस्ट अमाउंट ऑफ टाइम. हमको ये बताइए कि आपको कौन से काइंड ऑफ गेस्ट चाहिए. हमको ये बताइए कि कौन से क्वेश्चंस मुझे नहीं पूछने चाहिए थे, कौन से क्वेश्चंस मुझे और पूछने चाहिए थे ताकि आपको और ज्यादा वैल्यू मिल सके, और कौन से ऐसे पार्ट्स है जो आपको बिल्कुल पसंद नहीं आए ताकि हम लोग ये पार्ट स्ट्रीम कर सके फ्यूचर एपिसोड्स में. सो थैंक यू सो मच वंस अगेन फॉर वॉचिंग दिस एपिसोड एंड कीप शेयरिंग ऑल आवर एपिसोड्स विद योर फ्रेंड्स एंड कीप गिविंग अस फीडबैक so that we can improve and come up with better quality content.